Hello, Maverick Traders. Welcome out to your non-directional options module for Option Lab. These are always fun because we're going to look at real examples in current market conditions, see what looks good for specifically today, a butterfly or an iron condor. We'll kind of weigh the two, look at some different options, and then do a paper trade together. As always, make sure that these things are put into your trading plan, that you're assessing risk, reward, probability, what's going to work. Think about position sizing, especially in the demo account. And generally speaking, with this type of strategy, I'm of the mindset that starting small, smaller than you want to be, don't look at what you want to make. Look at what you can afford to lose. What's a reasonable drawdown? What if all of these go bad at once because of a market risk, some, cataclysmic situation where the market, remember, we have unique risk from stocks, but we also have overall market risk where if the market goes one way or another in substantial form, then any trade that is a non-volatility, a trade where it wants a stock to stay range bound, they might all go bad at the same time. So we always have to look at the worst case scenario, assume that it's even worse than what our worst case scenario is as far as what could occur, and then kind of build from there and work backwards and say, okay, it can probably be even worse than my worst case scenario, so let's figure out how to make the most of it. As you scan for these, in terms of what you're looking for, you could put together different pieces of criteria. It would probably pull up something along these lines where if you look at IBM, it's kind of interesting. You could go back 10 years and IBM's been a pretty dang good sideways candidate for 10 years, right? Think about how well tech has done and how well the market has done, and IBM has spun its wheels and gone nowhere. Now, of course, within that, there are phases where it has big volatility spikes to the downside or big volatility moves to the upside. And that's what you're kind of guarding against within this strategy is, look, there's going to be volatility even with something that goes sideways for 10 years. It kind of ebbs and flows, right? It comes and goes. So we kind of have to figure out, okay, where are we at in context? And we've got to figure out zones. If you can anticipate whether it's going to be a little more bullish or a little more bearish, that can be helpful. Where are we going in the short term, intermediate term, long term? And the market and the sector will have some influence. I think from a market perspective, the market uptrend is still intact. And if you look at the market versus IBM, it tells an entirely different story. You can see how strong we've been. Now we're rolling over a little bit today, but we've been certainly in an upward trend. I wouldn't be surprised if this thing doesn't finish with an upside move. So I'm giving the market a little bit of the benefit of the doubt in terms of more upside in the short term. And this is a very short term trade. So if we come in, you could look at this on a longer term scale. I don't know that that's super helpful. We're probably going to come in and look at it more on a shorter term basis because, again, we're only going to be in this for a couple of weeks. And then we've got to put some benchmarks around it. Now, I would look at it technically, so I would get a sense of where it's likely to be in terms of support down at 135. First, you could mark first supports, second supports, a little minor support in here at 137.5, a little bit more resistance up here, and just kind of see, what are the areas on this, and just kind of mark those up and say, okay, where are we at? Where are we going to be? And then it's sometimes even helpful on a chart to think about your expiration. Like if we were going to September 21st, I might even add additional bars. Let's add 2 weeks on here. And then, why did that not work? I didn't do it right. I need to add them there. There we go. So now if I add in some extra bars, it kind of gives me a way to forecast and say, okay, what are the next, really there's 14 days, but there's 10 trading days. So we actually have too much time here. It would be September 21st is your monthly expiration. So that's right here. What are the next 10 candlesticks going to look like? Well, this seems too close to me. Probably easily exceedable. I'm not sure that the stock can get either below 135 and sustain it, or above 143.50 and sustain it. So I'm kind of looking at this area as being, more reasonable. Call it 143-ish, call it 135-ish. That's kind of my zone. And what I like about this is the stock's at 138. So it has more room to rally. And since I'm, thinking that if we're going to have a spike, I'm still of the mind. I realize today's down, crypto's getting hit hard. I'm not so nervous. I still think we might see a little bit more of a spike before this thing's all said and done. So I kind of like having a little bit more room up and a little less room down. And we could do this in one of two ways. We could almost build a risk graph out here where we say, do we want to butterfly this, which means we've got to be more precise. We could butterfly it at 140 and have some sort of risk graph that looks like this, where we peak out in our profit at 140 and it kind of looks like that. Or we could build a condor that has risk and then kind of has an equal amount of reward regardless of where we're at, in this zone. So think about, I've turned the risk graph sideways to kind of say, well, where are the price levels? Do we want to make the same amount if it's anywhere in this price range? Or do we want it progressively more profit the more direct we can be with where it's at, right? Butterfly has bigger profit, but it's only in this top peak, which you've got to be more precise. The condor makes the same amount of money, but has a wider window, so just a little different style in terms of that. So those are some things to assess. What else are we going to do? Well, let's look at the market's opinion. So if I come in, there's a couple of ways we can do this. I'm going to zoom in a little bit. This is a probability cone, which is going to show the same thing as when we go to analyze. But let me show you what I mean. If I come out, we're on September 7th. If I go to September 21st, it gives me the probability range. And what's your range? Well, the top end of the range is 143, right about where we need to be. Right? That was the resistance. The bottom of the range, though, is 133. So it's telling you, look, based on where this stock can be, you're going to get hurt on the downside. You're not giving it enough room lower. So that's, something to assess, something to consider. Do we need to give it more room down than just a 135? Looking at the chart, we've got some support here at 135. But it's saying, look, based on volatility and such, it could be below that. I actually feel okay. I mean, it's aggressive, but we'll get more credit. We'll get better prices, which means less risk, more reward by taking a little bit lower probability, but we're in that zone. Another way to look at that, it's the same thing. So this is the probability cone where you can look at the expected range in this form with the chart. The other way to do it would be to come in, have some September. Well, we really don't even need that. We can just go forward. We don't even need to put in a chart. We can just do it that way and say, well, here's where it's at. It says, okay, we could be anywhere from about 143 to 133, so about 5 up, 5 down, somewhere in that range is the expected range between now and September 17th. That's the amount of volatility to expect. So reasonable to expect, 68% probability, right, that we're going to be in this zone. So we're good on the upside, betting on it being below that 143.50 resistance. we're aggressive on the downside because it's saying, look, it could easily get down here and leak down there. But again, I kind of like that, taking a little bit more risk to the downside because I'm just not so sure we're going to tumble hard in 2 weeks. Could it be company specific with IBM? Could they do something on their own? Certainly, that's a possibility, right? We want to assess earnings. Quick, easy way to figure out if earnings are going to be a problem is look when the last earnings date was. So that's July 19th. We know it's not going to come for 3 more months. So August, September, October. Okay, that's no problem because here is September 17th. We're not going to hit earnings. So is there going to be an individual stock catalyst? Perhaps. But I think that 135 level is kind of good where it should. Look at this on this chart. This shows it even better. Look at where my line is and look at this gap and look at this resistance. 135 is kind of a key level. This is even a little above 135, 136. But it's kind of a key level on the chart from the past back here, from, kind of an assessment. Is the chart a little more bearish than bullish? Yeah. I mean, I'm just not so sure it's headed for a huge breakdown in the next 2 weeks. I think it's choppy, and I could even make an assessment that it's bullish if we go up above this downtrend line, which I kind of anticipate might be more likely than the breakdown below this level of support. But to me, it's clearly consolidating and can easily do that for another handful of weeks where it's just kind of a tug of war. Kind of nice that today has a little uptick in volatility because that'll be priced into the options. People are getting a little nervous. Okay, that can help. So let's just come over and assess. Again, I'm only going 10 days on this, really short term. Probably, honestly, more short term than I normally do. But with condors, and that's what I'm going to build today, more than the butterfly, I'm expecting a zone, not an exact price. So I'm doing the condor. With condors, I do shorter term. Butterflies, I often use, watch my targeted butterflies video. That'll give you, I don't do a lot of neutral butterflies. It's not really my style. I do targeted much more often. I can't say I never do sideways butterflies because I will from time to time, but if I'm doing a really short-term trade like this one, it's probably a condor. So let's go ahead. Now this can get a little tricky. I'm not sure how they call this. Do they call it sell a condor? So they do. This is actually, see how I right-clicked and we sold a condor and it builds it correctly? That's a little tricky because that doesn't fit the actual true option lingo. I'm not sure you need to know this, but if you want to speak correctly, we're buying a condor when we sell for a credit. When we sell both credit spreads, a bear call and a bull put, and we sell that one and we sell, I don't know if it's two negatives make a positive or what it is. Interactive brokers, you'll notice, they call it buying an iron condor to get this structuring that we want. So let's take it down to one contract. And it doesn't really matter. We're just going to put every strike where we want anyway. But you got to make sure that your sell legs, your buy legs are above your sell legs. Let's just go with 2 for now. We like that 1. No, we don't like 138. What am I doing there? We want 143. We'll look at 143, 145 on the bear call. We'll look at 135, 133 on the bull put, and that has this between 143 and 135. That seems like a very small credit. Let's analyze this and see what it looks like. Doesn't seem like nearly enough. 34-cent credit for 166 of risk. That's way worse than I had anticipated. Yeah, it's probable. See this whole shaded area? It's probable that we're going to make money, but there's still a sliver here of losses that are very realistic. I thought we would get a little more credit than that. Let's go and look at these and make sure the pricing on it is correct. So I need to add a few more strikes. Yeah, that's only paying 20 cents on that side, and this is going to pay even less, 10, 15 cents on that side. So that's not great. That volatility is extremely low. I thought it would be a little better than that. You can see here, even at a 35-cent credit, it's just a bad risk to reward, worse than I had expected. 165 risk, $35 reward. I think that doesn't pass the test here. So I hadn't planned on it, but let's build a different style trade. Let's see what something else looks like. I was doing some homework and went, oh, IBM, this looks good. Okay, I like that, I like that, I like that. Didn't look at the risk to reward and don't like it. So let's see what a butterfly around 140 would look like. I'll do the call side because whenever I do a butterfly that's a little above, I use the calls. When I do a butterfly that's a little below, I'll use the puts. Okay, let's assess this. So again, we're going kind of targeting this to be in that range. This is a little better. Let's just take it down 1 penny so it's at a round number, because this will show you 240 risk, 260 reward. Certainly a lot better. And still, but you can kind of see the assessment here. So if we think about the shaded area is where it's probable to be. We're certainly in that shaded area, but we got to be in this area, stock price wise, to make money. That still leaves how much probability in terms of risk? Well, this part of the shaded area is risk, and this whole part. So it's certainly more bullishly skewed, like we had intended. But there's your kind of probability. And of course, all of this would be loss, and all of this would be loss. Now that's a lower probability. We could snap these. I'm going to set slices to break even at expiration, which will give us a probability assessment, kind of what we were looking at. And it says, look, there's a 37% chance you land inside your profit zone. But that implies there's a 63% chance you're outside of it. And again, that doesn't pass. You don't want to risk 240 to make up to 260 and lose 63% of the time. I don't think that, this is kind of the problem with these real neutral butterflies is, again, they don't really fit the bill. We're in a low volatility environment generally. Low VIX, low option premiums kind of imply worse numbers for neutral trades. If you think about it from the standpoint of, it's a teeter-totter, but when markets perceive that risk is high, you get, for neutral trades, your risk to reward is better. Okay, let's call it reward to risk, is higher. It's better. You're going to give you more reward and less risk for doing this trade, because the way it'll price out is, imagine this butterfly or this condor. For the condor, they'd have paid you a bigger credit, which means bigger reward and in turn less risk. The butterfly would cost less, which means lower risk and bigger reward, right? When the markets say, well, the risk of this thing going wildly is very low, then you get worse risk to reward, because this is essentially the probability. They're assessing the risk. How likely is this thing to go crazy and whatnot? And so that's a little bit of a problem we have here in IBM is, well, they've fallen asleep on IBM. and they just don't think the stock can move much and doesn't have much volatility, and it's probably right. It's probably not going to move much, which is what we liked about it. Let's think about additional ideas here. So just brainstorming and thinking about some of the markets that have a little bit more volatility. If I think about something like financials, it's lagging here the last few days, certainly. Could there be something in the financial space, something in the industrials? Energy and materials could be interesting. Energy and materials certainly have the volatility component. So let's think about those in terms of a little bit more range-bound type of trading. Wanted to see something that makes a little bit more sense. So energy, again, kind of looking at levels here where energy could be over the next handful of days. This is one, you kind of had a finishing move here, a little bit of an exhaustion plunge and then recovery. When that happens, there's a lot of times, this would be a perfect time to put on a sideways trade, in my opinion, just after exhaustion. What is an exhaustion? Well, basically overextended trend, overextended current trading range, and then big explosion in volume. And what happens is you go the other way, and then you often go sideways. So after this bounce back up, play this to go sideways. So it's not the worst look by any means. You can see it in both directions. I was looking at AMD earlier today, and it has the same thing in reverse. Overextended trend, overextended trading range, and see how the volume exploded. You get the exhaustion. So you had zoomed, it's boom, bust, sideways, right? So after you see, you're like, okay, exhaustion looks like it's materializing, you get the reversal, then you play it for the sideways for those few weeks after, and volatility will still be high, people will be nervous, you'll get good numbers, good price action of the whole combo, okay? So just after, if somebody said, what are you looking for technically? I'm looking for, an exhaustion move that reverses hard, because then the tug of war begins. That's my favorite pattern for a sideways trade. Spot an exhaustion, get the reversal off of that, then it goes sideways for a handful of weeks, and that's picturesque. So, energy kind of has it's like AMD. It's already been going sideways. Kind of had the exhaustive move, the reversal. We're probably a little late because it's already been doing the sideways for the past 8-9 days. It would have been perfect, but could it still stay sideways for a couple more weeks? Perhaps. And so you would look at that, and you might even dig into, something, other sector, other industries within. So this is oil services rather than including all of the oil conglomerates and whatnot, and just try to kind of build a trade. And if we looked at this, let's just go analyze here, and let's go forward to September 17th. It says, okay, for OIH, the oil service stocks, we're here. We're probably going to be below 200. We're probably going to be above, 173. That's the probability. You might have to skew a little bit. Do I think it's going to gravitate a little more up in price? Do I think it's going to gravitate a little bit more down? And try to build your risk graph to where your profit zone, if I thought it was going to be lower, I'd have more of a profit zone on this side. If I thought it was going to be higher, I might have more profit zone on this side, that sort of thing, and kind of build it accordingly. You do that with your strike price choices. So if we look at the chart, below 200, I agree. Above, you might even get a little bit more aggressive on the bull side and say, well, I really think this thing can be above 180. See the bounces here at 180, I mean, that's tight. You're giving, again, less room for it to drop. If the market helps and such, then that can be reasonable. So if we come in and we build a trade here, let's delete IBM, and just out of curiosity, so we'll sell Iron Condor. Let's just see what this looks like. Whoops. Take it down to 1. We'll give it more room up, like we said. I don't know if we'll get anything going that high. Let's see what it looks like. That doesn't even trade. Okay, so 115 credit on that. Roughly, maybe a little less because it's including these puts. And then we were going more aggressive on the put side, giving it less room to fall. You know, that's a better risk to reward. 2 to 3. Let's analyze. So this looks a lot better in my mind. You're going to make 200 bucks if it's anywhere between 180 and 195, that $15 per share window. You're still going to make some profit even if it's below 180 or above 195 if it's still within those break evens. You're going to lose max loss if it's below 175, and there's this much probability of that, you know, in terms of likelihood. And you're still going to lose on this side at about that much probability. Well, I guess losses, not max loss, but loss zone is right here and right here in terms of the probability. See how you have a bigger, you know, probability of loss down and a lesser probability of loss up. And then, of course, if you get the gigantic move, you were just dead wrong. If you get the big up, the big down, you had volatility all wrong, you had the trade all wrong, you know, and the assessment. And here, your max risk is 300, but that's a lower probability. Your max reward is 200. That's got a decent probability of success. In fact, let's set our price slices to break even at expiration. And it says, look, there's a 52% chance you're going to be in your profit zone. So in order for this to work based on those numbers, if you're just going purely on the statistics, still don't love it. 200 reward, 300 at risk. You know, let's see how likely a max loss. Max loss isn't super likely. We can drag this out to our max loss and max loss zone, and it says, look, there is a 14% chance here, a 20%. So you only have a 34% chance of max loss. You have a 66% chance of less than max loss. You know, and that's what it's saying, that look, you have a better probability of max reward than max loss. But this is kind of the number breakdown. You still have about a 34% chance of taking the full $300 loss. More likely, you know, 2 out of 3 times, you're either going to lose a little or make a good amount. So that's kind of the breakdown of the numbers. Much, much more reasonable than the IBM example in my mind. Yeah, in terms of this trade, all of these options are out of the money. So it's got a window here, right? And assuming we finish anywhere in here, there would be nothing. This whole trade would expire worthless. Imagine you finish at 185 or 190 or 195 or whatever. Everything goes away and you make that credit. So these are higher probability legs of expiring. Lower delta legs, both on, you know, the shorts and the longs. And that's kind of what this trade looks for. Now, you know, risking 3 to make 2, you can see that that's a little backwards. But again, there's only a 34% chance of taking the max loss. When I trade iron condors, watch the delta hedging video. boy, if there's any strategy that you better know how to delta hedge, it's credit spreads. Credit spreads are great because you get time decay working in your favor. So if you can hedge off the delta and reduce that risk, but still keep getting the theta daily, that's the way to succeed with these. So I don't trade credit spreads without being game planning for delta hedging to a certain extent. Now, I don't have to go delta neutral, but I might hedge the delta. What does that mean? Well, if I have a negative 20 delta that's hurting me, I don't have to hedge the whole thing, but I could add 10 delta and hedge off half of that delta risk, which in essence takes down my risk in terms of the price move going against me. Now I'm losing 20 here, but I'm making 10 here. I've reduced my delta risk. Sometimes you could even go delta neutral. If you have a negative 20 delta hurting you, you add 20 positive deltas and you've neutralized that. You're still getting the theta benefit. So definitely watch the delta hedging video for more information on that. No question. That is something you're going to want to do. So coming back here to kind of tie a ribbon on this, butterflies and condors are used for sideways stagnant price action. The put, iron, call, butterfly, condor, they create the same risk and reward, right? Whether you use one butterfly or another, whether you use one style of condor, if you put them on at the same expirations and same strikes, it's going to create the same risk and reward. Well, they don't always create a credit. The condors, well, I don't think that's a true statement because a lot of times the butterflies will end up, but basically it'll end up with a max risk, max reward number that sometimes will be where, maybe you'll take a little bit more risk than reward because of the probability of success. Thinking of them as two vertical spreads can help with management. If you're doing an iron condor like we did as our examples today, then those will always be a credit trade. But sometimes butterflies will be debit. Sometimes the iron or the just a call condor, put condor, they'll be debit trades. But it'll still end up with the same risk and reward and probability if done at the same strikes with same expiration and such. So hope you've enjoyed it. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.